Here's an example of inventory cost accounting using the average cost method. We will do the inventory accounting for a fictitious company called Toy Giraffe Inc, a company buying and selling toy giraffes. In the first quarter of the year, Toy Giraffe Inc is building up its inventory. In January, they buy 100 units, packed in 2 boxes of 50 units each at $5 per unit. In February, 200 units, 4 boxes of 50 units at $6 per unit. In March, another 100 units, 2 boxes of 50 units at $7 per unit. The cost per unit for buying these toy giraffes is going up fast. The Q1 ending inventory is 400 units at a total purchase price of $2,400, so on average $6 per unit. In the warehouse, the company does not specifically identify the boxes, they just stack them on a big pile. The same goes for cost accounting and inventory valuation using the average cost method. Stack the boxes on a big pile and blend the weighted average cost together. $6 average cost per unit is all we need to remember going into Q2. We can now perform the cost accounting for the next few months, where we start selling the boxes of toy giraffes. AVCO, AVCO, means average cost. The ending inventory of Q1 is the beginning inventory of Q2. 400 units at $6 each, $2,400 of inventory value in total. The first box of toy giraffes, 50 units, is sold in April. We will do the income statement accounting vertically, in the middle, and the inventory accounting horizontally. Revenue is 50 times $10 is $500. Cost of goods sold, or COGS, is 50 units times $6 average cost per unit is $300. And gross profit is $200. 50 times $4 per unit. 350 units, beginning inventory, minus units sold, remain in inventory at the end of April, at the average cost of $6 per unit, so $2,100 of inventory value. The ending inventory of April is the beginning inventory of May. 2 boxes of toy giraffes are sold in May. In the income statement for May, revenue is 100 units times $10 is $1,000. Cost of goods sold, or COGS, is 100 units times $6 is $600. And gross profit is $400. The remaining 250 units, beginning inventory minus units sold, go into the ending inventory at the average cost of $6 per unit, so $1,500 of inventory value. The ending inventory of May is the beginning inventory of June. 4 boxes of toy giraffes are sold. Sales are really picking up the pace. Revenue for June is 200 units times $10 is $2,000. Cost of goods sold, or COGS, is 200 units times $6 is $1,200. And gross profit, 200 times $4 is $800. The remaining 50 units go to the ending inventory, once again at the average cost of $6 per unit, so $300 of ending inventory value. It is useful to perform a physical count at the end of the quarter to verify that the expected number of in-inventory units shown in the accounting system is physically there. The average cost method for inventory accounting is very simple, especially for companies that deal with large volumes of very similar items. Average costing requires minimal work to apply and is, therefore, the least expensive of all the inventory cost accounting methods. The average cost inventory method blends all purchases together and comes up with one number per unit to apply in both cost of goods sold in the income statement and inventory valuation on the balance sheet. What is the difference between the average cost method on one side and FIFO/LIFO on the other side? The average cost inventory method blends all purchases together and comes up with one number. FIFO and LIFO are cost accounting fictions that use a concept called inventory layering. For cost accounting and inventory valuation purposes, when using FIFO or LIFO, the company needs to keep track of the timing of the buys and the unit cost. Let me show you how that works. The visual representation of the FIFO inventory flow is at the top. LIFO is at the bottom. The first box of toy giraffes, 50 units, is sold in April. With FIFO, first in, first out, we assume that the oldest inventory gets sold first, one of the boxes purchased in January. With LIFO, last in, first out, we assume that the newest inventory gets sold first, one of the boxes purchased in March. 2 boxes of toy giraffes are sold in May. With FIFO, first in, first out, we assume that the oldest inventory gets sold first, the last of the boxes purchased in January, and one of the boxes bought in February. With LIFO, last in, first out, we assume that the newest inventory gets sold first, the last of the boxes purchased in March, and one of the boxes bought in February. 4 boxes of toy giraffes are sold in June. With FIFO, we assume that the oldest inventory gets sold first, the remaining 3 boxes bought in February, and one of the boxes purchased in March. What stays in inventory at quarter end under FIFO is 1 box purchased in March. With LIFO, we assume that the newest inventory gets sold first, the remaining 3 boxes bought in February, and one of the boxes purchased in January. What stays in inventory at quarter end under LIFO is 1 box purchased all the way back in January. Why should we care which month the box comes from? Because it impacts the ending inventory value on the balance sheet and profitability in the income statement. That's why. When applying FIFO, the ending inventory in June is 50 units valued at $7 per unit, $350. The ending inventory under FIFO, in this example, is $50 higher than that under the average cost method. And if the inventory value is $50 higher, then the cost of goods sold, the offset, is $50 lower. When applying LIFO, the ending inventory in June is 50 units valued at $5 per unit, $250. The ending inventory value under LIFO, in this example, is $50 lower than that under the average cost method. And if the inventory value is lower, then the cost of goods sold, the offset, is $50 higher.